So why do existing homeowners refinance? What are your thoughts about it?
Could come into play for any number of reasons. There are multiple factors that come into play. I suppose the biggest one of them is probably cashback and interest rate combo.
This one is coming from a heartbreaking situation. If a couple is separating, how does refinancing work in those matters? Because first of all, you're already going through the pain of separation,
Yeah,
and now you have a burden of the commitment which you did with your partner that you will be helping in the repayments,
yeah,
and now things are falling apart.
yes.
They have to make financial decision. Where does Gaurav come into the picture here?
Trust me, it's not a great space to be in, but I've had scenarios where I had to sort of have those conversations with the clients and figure out what's the best way forward.
So before even somebody should reach out to a financial advisor, they should actually write the problem down, right?
In an ideal world, yes.
Yeah.
Yeah.
So now आज का जो हमारा topic है guys, that is about refinancing. So you have got into the market, you have set your rates, you know your income, you know your expenses, and you want to have that little bit extra flexibility where you can enjoy life while living it. That's where the role of Gaurav comes in. He's the financial expert. And if you are planning to refinance your loan in terms of better cashback, better interest rate, or even if you have extra money and you want to invest somewhere, we are going to take care of everything for your financial goals. So welcome to today's podcast.
Thank you.
Gaurav, thank you for taking out time from your busy schedule.
My
I know
pleasure.
you are loaded with a lot of people helping them day in, day out. So let's start with the topic. So why do existing homeowners refinance? What are your thoughts about it? Okay, let me give you a heads up. Is it scenario based because there are so many factors which involve restructuring, or is it which is something is in trend right now?
See, refinance could come into play for any number of reasons. There are multiple factors that come into play. I suppose the biggest one of them is probably cashback and interest rate combo. जनरली क्या होता है कि किसी भी बैंक के साथ अगर आप साइन अप करते हो, you move your home loan with them. They give you cashback and then they expect you to stay with them for 3 years, or in some cases 4 years as well. और अगर आप वो लोन को ब्रेक करते हो and then you move somewhere else, then they ask you to pay that back. But at the same time, after completing your 3 years with them, you can negotiate with them on cashback, but in many cases it works out better for you to move elsewhere. And it's not just cashback, it could be for better interest rate, could be better restructure, you're looking for a top up, or in few cases you may also be looking at an offset or a revolving facility which may not be available with your current bank. So there's a number of factors come into play, and it generally starts with a conversation with our clients where we say, hey, your loan is coming up for renewal. Do you want to refix it with the existing bank, or do you want to look at refinancing? And depending on what their next objectives are, we take that call whether it makes sense for them to stay or move.
If somebody's interest rate is about to expire, so they locked in for 1 year, 2 year, and now can it be done in the parts? Like for example, some part of the loan will be fixed for 3 years, some part of the loan is fixed for 2 years, and some is on flexible. So can we break it into parts as well when we are refinancing? How does that work?
Yes, you can break it into parts. At the same time, you need to be mindful that if you have locked in half of your loan portion for next 2 years and you want to refinance, you kind of have to look at whether there's going to be any break fee cost. In many cases, it can be substantial. I suppose it depends. If the interest rates are dropping, then chances are that you would have to pay higher break fee. But in the current environment where the interest rates are going up, the break fee may or may not be that substantial. So in such cases, we can always look at refinance as one of the better options. But at the same time, we kind of have to look at your overall picture and then see if staying with the current bank makes more sense.
Another thing is that my bank retention rate is higher than any other bank offer. Is that enough reason to refinance? Can you break this down?
Yeah, so I suppose when you say retention rate, I'm assuming you're talking about interest rate.
Mm-hmm.
So yes, that could be one of the reason, but as I said, you shouldn't just look at it from the point of view of interest rate only.
Mm-hmm.
All banks come up with different sort of offers. So at any point in time, chances are that there would be at least one bank, if not more, who will be offering you better rate than your current bank.
Mm-hmm.
But at the same time, you kind of have to look at what are you going to lose by refinancing. So it could be a break fee, could be cashback, clawback, and on top of that, you may have to pay lawyer fee for refinancing. There are certain banks who offer free refinance service via their own solicitors, but many others expect you to
Hire someone
get
and get it done.
independent
Yep.
advice, and for that you have to pay. So again, you kind of have to look at that in totality, and it usually starts from where you stand right now and what really you want to achieve out of it. So yes, interest rates do come into play,
Mm-hmm.
but they're not the only reasons through which you should refinance.
Basically, if somebody got a deal where they were getting the cashback, we got the cashback, and now the refinancing come into the picture. What happened to the cashback? Do they need to pay it back to the bank, or do they still get it with the new one, or what's up with the cashback?
Yes to both. So if you're refinancing before the term you signed up for at the
Mm-hmm.
beginning of your loan,
Mm-hmm.
which is usually 3 years with most of the primary banks these days.
Mm-hmm.
There are a couple of them with 4 years lock-in period as well.
Mm.
Let's say if you're breaking the loan after 2 years, then you kind of have to pay one third of that cash back you received back to the bank. But at the same time, you may receive higher cash contribution from your next bank. So it kind of works out the same or better in many cases. But
Mm-hmm.
again, you have to look at what other
Scenario to
factors can
scenario.
dictate that in terms of whether you're better off
Hmm.
or not.
So much work, man. This is too much work.
There's a lot of number crunching,
Yeah.
and at times you kind of have to keep up with what.
Like you have to think of each and every possible scenario from both client side and the bank side.
Yes, yes, absolutely.
Then only you can begin the conversation. And I don't think 90% of the people are willing to take this much of pain.
Absolutely right,
You
and then
can.
that's probably where we come into picture, because yes, you can walk into a bank and get your loan refinanced probably quicker than most of the mortgage advisors, but at the same time, then you just reaching out to the first bank you see, or the best logo in your head. But this is precisely where we advise people to come and talk to us. We're not here to make your life miserable. We are here to help you achieve the best outcome, and that could be by cross shopping across different banks and looking at which bank would
Because
suit you
you would
better.
know more strategies than somebody who is going for refinance by themselves.
Yes,
You would know the nuances of the bank. You would know the procedure because you have done it hundreds of times.
yes,
And that person
absolutely.
might be just doing it once or twice.
Yep,
They
yep.
can reach out and then. But out of how many, like for example, out of how many people refinancing in a month, how many use the bank directly and how many do it by themselves? Would you have any idea? Any rough guess?
Well, I can't really
Ballpark figure.
I can't really say for sure, but I would think, if I can't really talk about any other individual, but all I can say is the clients who work with us generally tend to stay with us for longer period, and we try to maintain that relationship with them, where we are doing constant check-ins and making sure that if their circumstances have changed or their requirements have changed, then we cater to that before they feel like they're lost and they don't have any where to go, and then they start checking statements on social media which can redirect them into a wrong direction. So it's all about making sure that you stay in
In
touch
touch.
with
Yeah.
your clients, understand their requirements, keep up with how their life is evolving, and see where you can add value further and further.
So if let's say my loan is fixed for another 1 year, can I refinance now?
Yes, you can,
Okay.
but the question is whether you should do that or not.
Yeah.
If you have a clear reason for that, I need to know that first.
Mm-hmm.
But as I said, more importantly, we kind of have to look at it from a wider angle. There would be a break fee involved, there might be a solicitor fee involved, and what exactly are you gaining out of refinancing? In many cases, it could be a better product with a different bank, a top-up opportunity, a better cashback, better rate. So yes, these are the factors that prompt you to think about moving elsewhere. But if you are with a bank you just recently signed up, there has to be a very good reason why you would want to switch within first year.
So let's say if the loan was for 5 years and I am on the last 1 year of that term of 5 year lock-in term.
Hmm.
So what happens then? Because there might be people like, for example, in 2020 they locked in for 5 years, 7 year, 10 years, hoping that the interest rate will remain at that level only.
Hmm.
But then later on, when the interest rate went up and they struggled to make those payments, they would have actually spoken to the bank again on their current circumstances, because that was the case what I heard that everybody was facing, because
Hmm.
the mortgage payments went through the roof
Hmm.
and everybody was struggling.
Hmm.
But now it's not the case, or how it is the case now.
Interestingly, I actually have a client who did exactly that. So they bought their first home in 2022 and they locked it for 5 years at a higher
Wow.
rate, thinking that the rates would go up from there. And again, nobody can predict the future, but at that time, that was their rationale.
Mm-hmm.
And then the rates started dropping pretty much from second month onwards. So unfortunately, when that happens and the wholesale rates drop, it's a complex algorithm that the banks can calculate for you or we can help you with.
Mm-hmm.
But by and large, they would have had to pay a large break fee. We were talking in excess of 30,000 just to break that loan at that stage.
Whoa.
So it wasn't possible for us to just switch them to a lower rate. But at the same time, you kind of have to look at it in totality across 5 years. How much would you save if you had the opportunity to break now and go on a lower rate?
Yeah.
If the answer is yes, you will save substantially higher and you can manage that one-off break cost. I'm not talking 30,000 here,
Yeah.
but
Yeah.
realistically, say $1,000 or $2,000,
Hmm.
then it might still be worth it,
Yeah.
because then you might be saving on month basis at least $300 to $400, which would give you a better return than sacrificing $1,000 break fee at this stage. So yes, it is definitely possible, but as I said, this is where we expect the clients to come and reach out to us, and then we can work out a plan and we can build a sort of staged plan for them and make sure that they come out better once they execute it.
So let's say if a client is approaching you, so I come knocking your door, Gaurav, I want refinance. How much time will it take you to actually analyze, is it even worth going into refinancing, or we should drop the idea right now and this is the better strategy which will either help you repay the loan or will help you save bit of money, time, effort, whatever the outcome? Because once the client get in touch with you, they would know how Gaurav works. So how much time does it take to crack that?
You would be surprised to know that many clients who reach out to us have certain notions in their head and say, okay, this is what I want to do, but they don't know the repercussions of that. So they make a lot of assumptions and think, okay, now we can refinance. But that's where having an honest conversation helps. So my emphasis has always been to have an open conversation about what exactly they want to achieve, where do they stand, and whether that's possible or not. To answer your question, you kind of gauge it within first meeting itself, where it's gonna go, but then you kind of have to break it down into smaller layers as well and see, okay, these are their objectives, and work backwards from there and figure out whether they can
Achieve
achieve
it
it
or
or not.
not. Yeah.
But Yeah, you generally know it within first 30 minutes of having that conversation, whether
And the
that's
whole refinancing, let's say first initial call happened, understood the objective of the client, you figure out that okay, this is doable and not doable. Let's say we are going on a positive scenario, it's doable, and you have calculated this is the amount which you are going to save if you take this step. Now let's work on it.
hmm.
And everything is rosy goldy, everything you got. What is the time period what banks take generally in an ideal situation, which
Hmm.
always not been possible, but
Hmm.
in the best case scenario, how much time will it take?
So again, it depends on the quality of the documentation and the application we present. Generally, there's an ETA of 2 to 5 working days with the banks where they start looking at the application, and then from there on, it depends on the overall profile, what sort of supporting documents we provided and how we presented it. I've had scenarios which I've had applications which have been approved within 10 minutes of the assessor picking it up.
Wow.
So altogether, I would say between 2 to 3 days from the moment we submit the application.
Mm-hmm.
But this is for an happy path scenario where things are not so great, or where we have to provide certain mitigants. And by mitigants, I mean where the banks may have certain apprehensions or concerns about the overall profile, but that's where we come in and help them understand the client side of perspective as well.
Mm-hmm.
Once we provide the mitigants, and the assessor generally look at it again, and then pass that feedback to us, and then we kind of go through that over multiple rounds before we get the approval. So in an ideal world, yes, 2 days. In not so ideal world, it could take 1 to 2 weeks.
That's absolutely perfect. If that 2 weeks of work somebody else doing for you, not even taking a single penny out of your pocket, working in your favor and getting the deal done, that's again an ideal situation. That's
Isn't it
what Gaurav
amazing?
is known for. So let's
Where have you seen this, where you get an expert by your side,
free
and you
of
don't have
cost.
to pay them anything to avail their
Yeah.
services?
So because in my process, it takes anywhere between minimum is 3 months and maximum it can go up to 2 years as well. So I'm in that kind of business.
Hmm.
So I'm
We,
and
we should do a podcast on that soon. So guys, watch out for that. We're gonna talk about Chucky's journey, hopefully within the next few weeks. But for now, we'll just stick to
sticking to
refinance.
yeah. So if my income falls, can I refinance using our repayments?
Yes, as I said before, you kind of have to look at what exactly you're wanting to achieve out of it. But purely to answer that question in terms of technical terms, yes, that's still possible as long as you service the loan.
And let's say if my family grows. So before I had one baby,
Hmm.
now I have another one. Does this affect the repayment, refinancing, or does it change the scenario?
Well, if you're staying with the same bank and you're still making repayments on time, the banks don't really need to do anything in terms of your home loan situation. But having another kid, one way or another, does eat into your servicing power.
Yeah.
So that's something that you have to factor in if you're refinancing,
Mm-hmm.
because your borrowing capacity may have dropped. But if your incomes have gone up,
Hmm.
then the numbers might still work. And as we were talking about earlier, there are so many factors which come into play here, especially with females, mothers who may have gone on
Maternity.
maternal leave. So in that context, we need to know when they're going to go back to work, what sort of time frame we're looking at, and each lender has different policy around it. So if, let's say, the mother is going back to work 8 months later, not every bank would be okay to just take that as an assumption and refinance you
Mm-hmm.
with her full-time income. But as a mitigant, we can look at her paid parental leave, or the income that she's receiving from IRD, as well as what sort of time period is remaining. So one bank might work out better for you than the other one, and that's exactly where as I said, we kind
So
of have to reach out to us. And
all the pregnant women, all the to be moms, all the to be parents, they should definitely get in touch with you so that they would know. I think Laksan has brought a new policy on this. Instead of 26 weeks, now you're going to get 30 weeks of
Yes.
parental leave.
Yeah.
So that is another factor which needs to be considered if you are expecting a new one.
Yes, absolutely. I mean, look, a number of times when you have another addition into your family, your um, goals change. You may be looking for a bigger house. You may be looking to consolidate your debt, or you may be even looking to downsize, just to
Make sure
make
that,
sure that you go through the first couple of years without having to feel that financial pinch.
yeah.
So as you rightly said, it pays to reach out to a financial advisor. It doesn't have to be me, but anytime you're in such a situation where you need to talk money and finances, my advice is that you should reach out to a financial advisor and we can help you from there.
Tough decisions.
Tough decisions,
Yeah.
we make them easier though.
Yeah, nice. And this one is coming from a heartbreaking situation. If a couple is separating, how does refinancing work in those matters? Because first of all, you're already going through the pain of separation,
Yeah.
and now you have a burden of the commitment which you did with your partner that you will be helping in the repayments.
Yeah.
And now things are falling apart.
Yes.
They have to make financial decision. Where does Gaurav come into the picture here?
Trust me, it's not a great space to be in, but I've had scenarios where I had to sort of have those conversations with the clients and figure out what's the best way forward. So typically, in such scenarios, one partner would hand over their shares to the other one. So in essence, a single partner would then become 100% owner of the property. So if they are with an existing bank, then we kind of have to look at the partners servicing as a whole, whether they can service all 100% of the loan. So these are the conversations we need to have and make sure that they understand the implications of them separating out and making that call that one of the partner would buy the shares out from the other one and then go on 100% ownership.
Do you sit with both of them and then have a word on it, or just advise one of them? Because there might be a counter offer
Conflict
from the other side as well.
Yeah, so it's generally a conflict of interest for us
Yeah.
to represent both parties. I'm happy to have an initial conversation in terms of just helping them in general. But when it comes to financial advice, we have to be very mindful of how that conflict can come into picture. So the answer is no. I can't work with both of them. But as a friend, as an advisor, I would see if they can keep that relationship on and then sort of go from there, strength to strength. But if it is going to happen, then we kind of have to talk about some hard steps. But in this particular context, I can only represent one client, not both.
Now let's go one step back. Young guy got his job, saved bit of money. Instead of renting out, he thought, let's buy a house. Did not had enough money that time, so he roped in his parents as a guarantor. Now the parents don't want to be part of that mortgage anymore. How does refinance work there?
So interestingly, I'm doing an application like that
You
this
have
week.
done pretty much all type of scenarios, right?
Yeah, we do come across a lot of different type of scenarios, and that's really is the exciting part about this job. It can be tiresome at times, but it keeps you going because you come across sort of different
Cases,
equations,
studies,
different scenarios, and you feel like you need to be able to
on
close
top
all
of
them.
it.
Yes.
Yeah.
But going back to your question, so when the parents come in as guarantors, banks look at it from both sides, whether the parents can service a loan if their kids drop out of that agreement, and it works the other way around as well. So if you are buying the house with help from your parents acting as guarantors, the banks would assess you not only on the loan that you are taking up with the bank, but also the money that your parents are giving to you as guarantors. So the banks would look at your overall assessment based on that. But when it comes to refinance, if they say that we're not going to be part of it and we need to take that equity out, then we have to look at whether your LVR situation has changed because of that. If it has gone up to let's say 80%, you're still under 80% threshold, then it should be fine as long as you can service the loan. The LVR has gone up, then I suppose in that particular scenario, it might be a bit more challenging for you to refinance. And then again, the question would arise whether that would be the best strategy for you. So different factors, different routes, but where you want to get to is where we help you, in reaching there.
So before even somebody should reach out to a financial advisor, they should actually write the problem down, right?
In an ideal world, yes.
Yeah. In this situation, like when parents are pulling apart from the deal or the kid is moving out, how does the problem will be defined in that case? So they just simply pick up the phone, write the number on the screen and say, hey Gaurav, this is the situation. What should we do? Yeah.
See, any sort of problem you're in when it comes to your finances, the very first step you should take is call us, explain to us what the situation looks like. You may not have all the answers or a clear problem statement, but even if you have a hunch or a concern, my advice is reach out and then we can break it down and understand where it could land in the future and sort of take proactive measures to avoid any sort of oh shit moment.
So now coming back to our serious topic. So let's say somebody is going in refinancing. So one bank gave you the loan of, let's say, 500,000, or that is the balance left in your loan. So there is a term called dollar to dollar. Please break it down for us to understand how this $500,000 will move to another bank and you are not paying anything. Rather, you are only saving.
Yes.
That's the objective, right? That's what we are going to achieve.
Yeah.
If we are able to achieve, we will move ahead. If we are not able to achieve, drop the plan.
Yes.
Yeah.
So I think to answer that question, I kind of have to go 3-4 years back when the market was at its peak, and a lot of first home buyers got into the property ownership. So they bought their first home at a premium price, so to say, and now the values have tanked or have come down at least 15 to 20%, which has eaten into their equity. So what that has done is a number of clients or homeowners are currently sitting at higher than 80% LVR. Or in many cases, even if you don't go that further back, let's say you bought your house last year at 90%. 90% LVR, which essentially means that you put 10% deposit and you got.
No, we pay 20.
I'm just
Okay.
I'm just saying hypothetical scenario.
Sorry. Yeah.
So if you as a customer, as a first home buyer, paid only 10%, then you're kind of sitting at what we call high LVR bracket, because anything less than 20% deposit or equity, what we spoke about last time, is considered a high LVR situation. And what that means is the banks generally don't offer you the best interest rates and cash contribution. You are put on a higher interest rate, which essentially means that they've added margins into the mix to cater to the higher risk that you bring with you by going on 90% LVR situation, right? So in these circumstances, one bank might, or the current bank you with, they may be charging you a higher premium, higher interest rate, but there could be another bank who's offering you a slightly better rate or a better cash contribution. So in such scenarios, we can refinance you as is, and that's what we call dollar for dollar. The term dollar for dollar essentially means you're not taking on any additional debt by moving to another bank. And it's actually exempted by RBNZ that dollar for dollars refinance scenarios should be assessed slightly differently to say you buying a house altogether
A
brand
new
new.
one, yeah. Or first time in the market.
Yes, because with dollar for dollar, some banks even offer less documentation or less scrutiny of your overall situation. They can also essentially give you, better sort of borrowing capacity because then you're not constrained by DTI rules or your surplus requirements, because every bank tests you on a certain surplus level whether you can afford to pay that money off over a month or so. But with the dollar for dollar, that condition is slightly relaxed. And in this environment, a number of clients are actually in that situation. A number of first home buyers who bought their house in last 1 to 4 years are in that situation. And at the end of their term with their current bank, they go scratching their head thinking, what should we do next? Because we're already paying higher rate. We're not getting any support on cash contribution. And in many scenarios, they feel like by doing certain improvements in their house, the values have gone up, right? But it hasn't reflected on their, valuation yet because nobody has conducted a registered valuation. So I suppose the fact, so dollar term is essentially used when you're moving your existing loan from one bank to another without taking any additional debt. It's quite handy because it's exempted by RBNZ in terms of many criterias. And what that does is that allows you to refinance it to another bank in a shorter time frame with less documentation, and in many cases for better interest rate and cash contribution. So imagine if you're struggling with your repayments because you've already taken on quite a lot of debt and you're wanting to reduce that as much as possible, or in another scenario you just want to unlock additional cash back to go on a holiday trip, to go take a ski tour to Queenstown. So that essentially allows you to do that. But the key factor here is not taking any additional debt. It's quite handy for first home buyers who bought their house at a higher LVR position, because then we can look at if there are other lenders who can give them better rates. But this could also be useful for investors where the property value has gone down, or they initially intend to use it for owner occupation purpose, but now their plans have changed and they moved it to a rental. So in that context, we can still keep it under 80%. We don't have to sort of manage it under 70% LVR situation. So it's useful for first home buyers as well as investors who may be thinking that their current bank isn't offering them a better rate or a cash contribution option. And that's exactly where, as I said, we guys come into picture and help our clients understand and educate on what could work for them in short to long term.
Nice. I think everybody who is planning to refinance are people who either are very smart, who want to navigate the waves and see how they can make better ROI with the existing repayments, what they are doing, or they are somebody who actually need help with their financial part, where they can reduce the stress and the burden of the money which they are paying for towards the cost of living.
Yes.
So whoever it is who wants the advice in terms of better financial decisions for their betterment of life, they should reach out to Gaurav and he will understand. He has got the experience under his belt, which is going to help you sail through the life in the most happiest manner. If not, then at least much easier manner.
Yeah, absolutely.
So thank you, Gaurav, for coming on to this show and enlightening us with your financial thoughts.
My pleasure, as always. Thank you.
Thank you.